Welcome to the Mad Podcast on YouTube. We're talking mergers, acquisitions, and deals. And in this episode, solicitor or lawyer, if you want to call him that, John Andrews shares his experience of helping business investors and entrepreneurs to acquire businesses. And he's going to be sharing with us small, medium, and larger acquisitions that he's dealt with. I think you're going to find it really insightful and interesting. So enjoy the show, and don't forget to like, share, and comment below. And please massage that subscribe button so that you can, and hit the notifications bell as well, so you get the latest episodes as they are released. So look forward to speaking to you soon. Enjoy the show. Bye for now. Hello, everyone. Welcome to the Mad Podcast. We're talking mergers, acquisitions, and deals. And with me today is John Andrews from JMW Solicitors. Welcome, John.
Hi, Sean. Yeah, nice to be here. Thanks for inviting me on.
Yeah, well, this is going to be interesting, and I really appreciate you coming along today. Most of my guests are, so far to date, have been entrepreneurs sharing their deals, their acquisitions. But today, you're going to be sharing your expertise about working with entrepreneurs who are buying these businesses and that are involved in mergers, acquisitions, and deals. So would you like to introduce yourself, John, and give us a flavor, if you like, of your background, please?
Yeah, certainly. So I'm a partner in a firm called JMW. We're based in the City of London. We've got an office in Manchester, but we act for clients all over the UK. I'm a partner in the corporate team, specialise in mergers and acquisitions and drafting commercial documents. The types of clients we act for range from, startups, people looking to get into this sector, into acquisitions, right up to large PLCs. So we do a broad spectrum of corporate commercial work, and as I say, with a real emphasis on mergers and acquisitions.
Okay, that's great. And so predominantly you've done small deals, medium-sized deals, larger deals, which we'll come to. But I just wanted to start with the smaller deals. Can you share with us perhaps a couple of examples of, I appreciate there's confidentiality around some of this.
Yeah, certainly. I mean, it's at the moment there's a lot of small deals going on. I'm probably running about 25 or 30 at the moment. That'll give you some idea of how active it is for me. And the way these deals are being structured is pretty ingenious, actually, in many ways. Is people getting into buying businesses without borrowing a huge amount of cash, without putting their own assets at risk. So to give you a typical type of example of a small deal that we're doing at the moment, many of the businesses that are being sold are owner managed. Some of them have had a difficult time through COVID, some of them have boomed. But what their managers or owners have decided is that coming out the other side, that they're looking for a retirement and exit plan. A lot of these businesses have accrued profits that the owners haven't drawn out of the business by way of salary or dividend. So the owners are sitting on a pot of cash. And some of them may also have taken out C-bill loans, bounce back loans, and they've got that cash that they've not used. A number of deals that I'm doing at the moment involve buyers coming along who say, right, we'd like to acquire your business. And the way these deals are being structured at the moment are the buyer agrees to pay a sum up front, maybe fairly nominal, might be £20,000, £30,000. A number of the deals I'm doing with at the moment involve that sum up front. In addition, the cash that's sitting in the company's bank is used as part of the proceeds, the purchase funds. So the seller is able to get those funds out at a 10% rate using the entrepreneur's relief, rather than paying income tax on those proceeds. The buyer comes in, they have the liability to repay the C-bill loan, which is still sitting in the business, but they've used that to fund the upfront payment. And then there's usually a period of deferred consideration. So typically 2 to 3 years over which there is a balance of payment to the owner manager. So to sort of summarize how the deal is structured, the upfront payment initially in a small amount comes from the buyer. There is a cash sum that is self-funded by the business that comes out because it's sitting there in the company's bank account. And then there is a deferred consideration. So that's a pretty typical deal that's going on at the moment.
Yeah, and it certainly has the elements that I'm familiar with. So when a new business owner, or there's going to be a lot of people listening to this that are looking at starting or acquiring their first business acquisition, how much risk is involved in these acquisitions, and how can new business buyers mitigate that risk?
Yeah, well, I think the biggest risk for a new buyer is if they're asked to put any personal assets on the line. So firstly, if they do the acquisition in their personal name, rather than setting up a company to do the acquisition. So the first thing I'd always be saying to anybody looking to get into this market is do these deals typically through a group structure. That sounds quite grand and quite complicated, but it's not. So what you do is you start off with an off-the-shelf company, which is your holding company. And you use that company as your central hub, okay? And then each time you do an acquisition, you either use that company to acquire the shares in the business that you're buying, or you set up a subsidiary company under that, which in turn does the acquisition. So that's more typical if you're doing an asset acquisition rather than a share acquisition. So the first point is, or the first obvious way to mitigate your risk in doing these deals is to set up a limited company to do the acquisitions. That then ring fences any liabilities within that company, and you personally are not on the line for any deferred consideration or payments that you agree to make in relation to the deal. The second way to mitigate your risk is to ensure that, if it's possible, and in most cases it is, avoid giving personal guarantees. So sometimes, if you're going to buy a business and you've set up this new limited company, the first thing the buyer's going to say to you, the seller's going to say to you, is, how do I know I'm going to get my money? Because it's a shell company that you've got there that's acquiring my business, and I'm going to have to trust you to pay me over the next couple of years. To mitigate that risk as a seller, they'll ask you for a personal guarantee. The way you respond to that is to try to avoid that at all costs, and offer some alternatives. And there are a number of alternatives that you can offer, which should in most cases satisfy a seller, particularly if they're a motivated seller who wants to retire and wants to get their cash out of the business as well.
Okay, so what are those options then?
So the options are, firstly, the most obvious one is if you are not borrowing money from an institution. If you're borrowing money from a bank, for example, to fund your acquisition, the bank will want to take a first charge over the business that you're buying. So if we work on the assumption that's not the case, that this deal is going to be self-funding, or you've got your own small pot of cash to put in up front to fund that first payment, the most obvious thing to do is to offer the seller a charge, or a debenture as it's known, over the business and assets of the business they're selling. What that then means is that if you default in making the payments due to the seller under the agreement you enter into, they can call the debenture in, they can appoint a receiver or an administrator to take over the run of that business, and if they want to, eventually take the business back. So it gives them some kind of peace of mind that if things go wrong, they have got a stick to beat you with, and they've got some security over the business they're selling.
Yeah.
So that's the first thing you can offer. If there is borrowing being taken by the buyer, and so a debenture is not going to work, there are other alternatives. So, for example, you could offer the seller a specific charge over any particular valuable assets that the business might own. So, for example, if it's a manufacturing business that you're acquiring and it has particularly valuable plant and machinery, you could offer them a specific charge over those assets rather than over the whole business. In the purchase agreement, you could agree to certain restrictions as a buyer. So you could say, whilst any deferred consideration is outstanding, you'll restrict the money you take out of the business. So you won't take dividends out. You will limit the amount you take out by way of salary, and that you will give priority to repayment of the deferred consideration. So the reason that can be attractive to a seller is that they know that the buyer is incentivized to get them paid as quick as possible, so they can start to realize the value of the business that they've acquired.
Yeah, I guess there's also property as well, if the business owns property.
Yeah, absolutely right. And again, if the business owns property and there's no bank involved who want to charge over that, again, you can offer the property as security.
Okay, so that certainly helps to clarify the risk level is involved. You mentioned it earlier about purchase agreements. So you can either buy the shares or you can buy the assets of a business. Can you just clarify, John, please, which option you'd recommend under what circumstances, please?
Yeah, I mean, and there are pros and cons of both methods. So if we look at share purchase first of all, share purchases typically are going to be the most attractive option for a seller, and the reason for that is tax. So if you own a business and it's a limited company, and you've owned the shares of that company for more than 2 years, if you sell that business, typically the tax you're going to pay on the proceeds of sale is going to be 10%. You qualify for entrepreneurs relief. So that's the driving force behind sellers wanting to do share sales. Share sales and obviously come with some risks, because if you're doing a share purchase, you acquire the limited company with all of its history. So if the seller has not accounted properly for tax, for example, if there are any hidden claims against that limited company, when you acquire the company, they come across with it. And the way that risk is mitigated against and protected against is in the share purchase agreement, where we as lawyers ask for certain promises from the seller about the business. If those promises prove not to be true, then we can sue for breach of contract under them. You also protect yourself in the process by doing a proper due diligence investigation. So you ask questions about the business before you enter into the agreement. You ask for documents to be provided, and you investigate the history of the company so far as possible. The advantage for a buyer of a share purchase is it tends to be a little bit more straightforward in terms of maintaining the business continuity. So if you buy the shares in the company, you don't have to worry about transferring contracts that the business might have with suppliers or with clients across to a new entity, because there's no change in the entity which is providing the services or buying the goods in. So that and also, if there is property that's owned by the limited company, that property comes across as part of the share sale. So you don't have stamp duty issues, for example, with freeholds that are owned by limited companies. Asset purchases, the advantage of an asset purchase for a buyer is that you leave all of the history of the seller behind. So you're not acquiring their company, you're not buying the shares. What you are doing is you are buying the business and assets, and you're putting those into a new company. That then means if there are any historical tax issues, any historical claims against the seller, they stay with the seller's empty shell company, which has sold all its business and assets out to your new company. So you have a clean sheet when you start with that business. The downside with that is that asset purchases can be a little bit more complicated, although people think that they're not. From a liability point of view, they're better for a buyer. But in terms of assigning contracts over and arrangements with suppliers, you may have to do individual assignments of each of those contracts. If the business does a lot of work with big institutions, so big companies, PLCs, local authorities or government, quite often they will be they will be a key factor in you wanting to buy the business. But those contracts will contain what's known as a change of control clause, which basically says if there is a change in the identity of the supplier, the customer, the client, has the right to cancel that contract. So what you have to do before you do the acquisition is contact that client, contact the local authority, tell them the sale is going to take place, and ask for their consent for the contract to transfer across. Lots of sellers don't want to do that because it then places those clients on notice that the sale's in hand, and if it fell through, that could cause difficulties. So, as I say, in many cases, the risk of doing a share purchase in terms of liability is outweighed by the fact that you don't have to go through that process with the asset assignment.
Yeah, so the share purchase sounds like a smoother process, but my understanding is that an asset purchase tends to be faster. Is that true?
I'd probably say not, actually. The reason I say not is that with an asset purchase, as I say, first we've got these contractual issues of getting the consent to the assignments. Secondly, if there is property, whether it's a lease or a freehold property, what you're adding to the share purchase process is a conveyancing process, because you need to get the lease assigned to the SPV, or you need to get the freehold property transferred across to your SPV. So you're adding another legal layer to it, and particularly where there are leases, you will need the consent of the landlord to transfer that lease from the seller to the buyer, and quite often that holds up transactions, because trying to contact the landlord, he will then ask for accounts for the buyer, for example, and if it's an SPV, he will then look into the buyer's background and might ask for a personal guarantee for the rent. So there are added complications which arise from the property transactions of an asset purchase,
which could drag out time.
Which could drag out, because that takes it with a share purchase. Generally, the timetable is in the control of the buyer and seller. So as fast as they can do the deal, and as fast as their lawyers can get the deal done, they can get the transaction through, because there's, generally speaking, no requirement for third-party consent or approval. With asset purchases, you're adding another layer of third-party consent potentially into those deals. Not all of them, but in many of them. Okay,
well, that certainly gives an insight into the risks and the best way to move forward. So what are you seeing at the moment? What kind of businesses are you dealing with? What kind of strategies are entrepreneurs using? I guess some of them that you're working with are buying and building. Is that right?
Yeah, I think that's right. And there are, at the moment, there are a number of sectors that keep me really busy. So care homes seem to be pretty popular at the moment. Gyms are a popular target. Nurseries and beauticians, nail, hair, any of those sorts of sectors at the moment. The ones which actually you would think during COVID and lockdown would have really suffered are the sectors where there's a really buoyant, active market.
And is that, so I would imagine all those businesses would have been closed, but now they're reopening. Some of the owners will be of retirement age and or just fed up and just want to get out. Is that right?
Yeah, I think that's right. And I think that the buyers see these markets, see these businesses now as being a kind of booming market. There's been a pent up demand, for example, for people to get their hair cut. Not me, obviously, but but there's a pent up demand to get your nails done, all these sorts of things. So, and what's happening is people, and lots of these deals actually are the CBIL loans, where people have taken the CBIL loans out, not actually used them, and actually they're being used to fund part of the purchase price. So I think for gyms and I think for beauticians, hairdressers, I think there's a pent up demand. and I think buyers see that market going forwards as being buoyant and being something they want to get into. And it also means that at the moment they can pick these businesses up fairly cheaply and with little upfront funding. So I think that's why they're doing very well. Care homes is an interesting sector because I think that it's personally, I don't think it's without its risks. That sector, I think going forwards, we've got the issues about whether staff have to be fully vaccinated, for example, how you're going to risk manage COVID going forwards. But there is a real appetite to acquire care homes at the moment, and a number of people, as I say, looking to sell them because I think that maybe they have decided they've been through a difficult time. It's time to step down and let somebody new take over.
Yeah. John, I'm curious, are you seeing these business buyers, are they experienced in these sectors, or is this their first acquisition? Because care homes specifically have this high barrier of entry. There's a level of qualifications and training required. So what was your view on that?
I think that it's a mixture, actually. Personally, I think if you're going to go into care homes in particular, I think it's pretty important that you've got some experience or knowledge of that market going into it. Unless I've one deal at the moment, which is potentially a large deal, where the purchaser hasn't got experience in that sector, but the business he's looking at has got a long established and large management team in there. So in each, it's basically going to be 5 to 6 care homes, part of a group. Each care home's got its own manager, who is the registered person for CQS purposes. So in that scenario, if you've got the experienced team in there who know what they're doing, and you are essentially going to be, you're going to acquire it, but you're going to let the business manage itself because you've looked at it and it's a well-run machine, then that's fine. But if you are new to that market and you're looking to acquire your first care home without an experienced manager, I think that's a tricky proposition to undertake. In other sectors, nail bars, hairdressers, stuff like that, gyms, most of the people who are acquiring those tend to have experience in that sector. They might be people who've worked in them, have now decided it's the time to go self-employed and take their first step and get their own business.
Yeah. Okay. So those are the kind of smaller businesses. I know you've worked on medium-sized and larger businesses. What about medium-sized businesses? Is there an example of one or two that you've worked on?
Yeah. So typically, we tend to think anything sort of like between £1 and £5 million, we'd sort of put in as a medium-sized deal. There's a couple of those going through at the moment. We've got I've got an estate agency and letting agency business which we're in the process of acquiring. That's an interesting exercise because the two elements of that business are very different. The estate agency side is transactional, so in valuing that business and deciding on how the payment for that is going to be structured, you have to look at the historical performance and what they've got on their books at the moment. And obviously, estate agents at the moment are absolutely flying. Whether that remains the case after the stamp duty holiday ceases is another question. And obviously, at the end of June, I think it halves the benefit, and then at the end of September, the stamp duty holiday goes completely. The letting agency side of it is a recurring income. We know how that works, and the only risk part of that business is drop off. So if people tend to like their letting agents and stay with them, if there's a change in the ownership of that, you have to manage that quite carefully. So in terms of structuring these deals, the letting agency part of that deal has a clawback clause for any drop off in the first 12 months. So on the estate agency side, we've just agreed a straightforward multiple of that, and that's funded up front and is being paid for by the clients completely.
Yeah.
And then at the larger end, towards the end of last year, I was involved in a £25 million sale of a logistics business. I do a lot of work in that sector because I live near Heathrow, so we've got a lot of those people based around here. I meet them at the gym, I meet them at the golf club, so you get talking to them. That was an interesting deal because they were acquired by a large American company. It was their first acquisition in the UK, so we had to get them accustomed to how we do things here, how the deals are structured, and it's interesting because the American way of acquiring businesses is very risk averse, and it puts a lot of the risk onto sellers, and you have to be wary of that if you're selling to a US buyer. So typically, in an American acquisition contract, they will ask the seller to give indemnities, and indemnities are far more onerous than warranties for almost everything. So a warranty, just to explain, it's a little bit tedious, but when you're selling a business, in the contract, as I mentioned earlier, you give promises about it. And those promises come in two forms. You have warranties, which are assurances you give or promises about the business, which you say, if these prove to be untrue, you may be able to sue me for breach of contract. Okay, but in order to sue on those warranties, you have to show, first of all, the warranty's been breached, and secondly, that the value of the shares in the business that you've sold, if it's on the assumption it's a share sale, have been reduced. Now, there might have been a breach and there might be some financial loss, but that may not overall have reduced the overall value of the shares. So they're not straightforward claims.
Yeah.
Indemnities are pound for pound indemnities. So essentially, the buyer is saying to the seller, if this event happens, you will pay me back on a pound for pound basis. So I don't have to prove loss. I don't have to prove that the value of the shares has been reduced. All I have to show is that this event has happened, and it's cost me on a pound for pound basis. So in this contract we have in the US, it basically said we had a number of warranties. The agreement ran to about 140 pages, 150 pages, reams of warranties, and at the end of it said is that you will indemnify us for all the warranties. So basically, trying to make all the warranties indemnities, and it's little things like that you have to look out for. And that's, I guess, where we earn our money, by saying you can't have that.
Yeah, that's not allowed. Maybe some people that are buying businesses will be thinking that's a good idea. Start using.
Yeah. I mean, if you can get away with it, it's brilliant. But
yeah, it sounds like you've gotten by the short and careless.
Yeah, exactly.
Okay, so that's fantastic, John. Thanks for that overview. So, what would you say to budding business buyers that are looking for that first acquisition? What kind of tips, advice would you share with them?
I guess I'd say, first of all, if you're going to do it, now is a great time to do it, because there is an appetite for a number of people to sell their businesses, and it's probably more affordable than it's ever been in terms of not having to put your own cash in and take huge risks. So it's a good time to do it. What I would say is pick a market that you know. I think if you understand the business that you're buying, you know what the risks in it are, you know what the benefits are, you know what kind of staff you need. I think that's a huge advantage. So pick a sector you've got experience in. I'd probably say to you, don't find one business and think you've got to have it. I think ultimately you've got to be prepared to walk away from a deal if it's not right for you, either because when you do the due diligence, it doesn't stack up, or if the seller is insisting on a contractual provision like the one we've just discussed, which is wholly unreasonable. Walk away from the deal and actually trust your gut feeling. If there's something you can't quite put your finger on, but you don't like about the business, 9 times out of 10, I think that feeling is going to be right.
Yeah, I think that's great advice, John. That, being willing to walk away from a deal is really, really important. And that's very much about, generating lots of leads, deal flow, so that you're confident about walking away, knowing that you've got 10, 15 other leads available.
You know what, you're right about that, Sean. And what's happening at the moment, again, a number of people I'm active for have just written out, they've either got a database, they've gone online, and they've written hundreds of letters in the sector that they want to acquire business in, and just wait to see what responses come in. You know, if you've got 10 possibilities, you know, walk away from the bad ones and pick the good one out of it.
Yeah, and you know, if they're really motivated and they can't find anybody else, they'll come back to you, and you get a better deal, right? So,
you know what? Exactly right. Exactly right.
Yeah. Okay. So, well, thanks again, John. It's been great chatting with you. So what kind of new clients are you looking for? Who would you like to speak to?
Well, as I hope sort of come across in this, I act for all sizes of clients. So if you've never used a lawyer before, but you want to dip your toe into the water and you want to start on this journey, acquire your first business, and you just want a discussion about how to do that, please get in touch. Up to experienced entrepreneurs, acquirers who are looking to consolidate, you know, businesses that they've got or move into new sectors. So, you know, any type of client who wants some corporate advice, I'm happy to talk to.
Well, you've certainly got that range of experience of deals as well. So that's fantastic. So how can people get hold of you, John? What's the best way?
Okay, so probably the best way to contact me is through email. So it's john.andrews@jmw.co.uk or via LinkedIn. I'm on LinkedIn as well.
Okay, well, fantastic. So if you're listening, you're watching, feel free to get in touch with John and you'll get some fantastic legal advice. Thanks again, John. Really appreciate you being on the Mad Podcast.
We enjoyed it. Cheers. Thanks, Sean.
All right, cheers, John.
Bye.
I hope you enjoyed that episode with John Andrews. You know, he really is an experienced solicitor or lawyer when it comes to acquiring businesses. Now, don't forget to please like, share and comment below. I'd love to hear your thoughts. And don't forget to hit that notifications bell so you get the latest episodes of the Mad Podcast when it's released. And incidentally, if you need help with mergers, acquisitions or deals, then please connect with me on LinkedIn and send me a message. I'll look forward to helping you. That's all for today. See you on the next episode. Bye for now. Stay safe and be kind to each other.